Index funds, ETFs. You've heard both terms thrown around like they're the same thing. Sometimes they are, sometimes they're not. By the end of this video, you'll actually know the difference and which one belongs in your portfolio. No jargon, no confusion, just a clear explanation you can actually use. Let's start at the beginning. What's an index? An index is just a list of companies that meet certain criteria. The S&P 500, for example, is an index of the 500 largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Google, and 496 others. The index itself is just a list. You can't directly invest in a list. That's where index funds come in. An index fund is a fund that tries to replicate the performance of an index by buying all, or most, of the stocks in it. So an S&P 500 index fund buys shares of all 500 companies in the S&P 500, weighted by their size. When the S&P 500 goes up, the fund goes up. When it drops, the fund drops. You're buying the whole market, not picking individual winners. This is the opposite of actively managed funds, where a team of fund managers tries to handpick stocks and beat the market. Spoiler: most of them fail to beat the index over the long term, and they charge you higher fees for the privilege of underperforming. Index funds say, stop trying to beat the market, just own the market. So what's an ETF? ETF stands for Exchange Traded Fund. Here's the key word: exchange traded. That means it trades on a stock exchange throughout the day, just like a share of Apple or Tesla. You buy and sell it during market hours at whatever the current price is. A traditional index fund, technically called a mutual fund, works differently. You place your order at any time during the day, but the transaction doesn't go through until after the market closes. You get the end-of-day price, called the NAV, net asset value. With an ETF, you can buy at 10:30 a.m. and sell at 2:15 p.m. if you want. With a mutual fund, you get whatever the price is at 4 p.m. Eastern. Here's where it gets nuanced. Index funds and ETFs are not mutually exclusive. They're actually two different attributes of a fund. An index fund describes what the fund holds. It tracks an index. An ETF describes how it trades on an exchange. So you can have an ETF that tracks an index, this is the most common type, an ETF that is actively managed, not indexed, a mutual fund that tracks an index, traditional index fund, or a mutual fund that is actively managed. When people say index funds versus ETFs, they're usually comparing traditional index mutual funds, like those at Vanguard or Fidelity, against index ETFs. And the truth is, for most investors, the differences are pretty minor. Let's compare them head-to-head on the things that actually matter. Minimum investment. Traditional index mutual funds sometimes have minimums. Vanguard's VTSAX requires $3,000 to open. Index ETFs like VTI, Vanguard's equivalent ETF, can be bought for the price of a single share, which as of recent years is around $200, $240. Some brokerages let you buy fractional shares, so you can start with $1. Edge, ETFs for accessibility. Expense ratios, both can be extremely cheap. Fidelity's FXAIX has a 0% expense ratio. Vanguard's VTI ETF charges 0.03%. We're talking fractions of a percent, practically a tie. Tax efficiency. ETFs have a structural advantage here due to how they handle trades internally. They rarely have to sell assets to meet redemptions, which means fewer taxable events. For taxable brokerage accounts, not IRAs or 401ks, ETFs tend to be slightly more tax efficient. For tax-advantaged accounts like Roth IRAs, this difference is irrelevant. Automatic investing. This is where mutual funds have an edge. You can set up auto-invest with a mutual fund to buy exactly $200 worth every month. With ETFs, you're buying whole shares, unless your broker supports fractional shares, so automatic investing is a bit clunkier. Fidelity and Schwab now support fractional ETF purchases, which mostly closes this gap. Intraday trading. ETFs trade throughout the day, mutual funds don't. For long-term investors, this doesn't matter at all. Actually, for most people, the ability to trade ETFs throughout the day is more of a temptation toward bad behavior, panic selling, market timing, than a real benefit. So, which should you use? For most beginners investing through a Roth IRA or 401k, it genuinely doesn't matter much. Pick one and stick with it. Here's a simple framework. If you're investing at Fidelity, use their mutual funds like FXAIX, total U.S. market, 0% expense ratio. No minimums, no friction, automatic investing. If you're investing at Vanguard, consider their ETFs like VTI or VOO, low minimums, extremely low fees. If you're investing at Schwab or another brokerage, either works. Look for broad market ETFs or index mutual funds with expense ratios below 0.1%. One thing to watch out for: not all ETFs are index funds. There are actively managed ETFs, leveraged ETFs, inverse ETFs, products designed for sophisticated traders, not long-term investors. If an ETF's expense ratio is above 0.5%, it's worth understanding what you're buying. Stick to broad market index ETFs from Vanguard, Fidelity, Schwab, or iShares BlackRock for simplicity. For most people, the portfolio is simple: a total U.S. market fund or S&P 500 fund, maybe a total international fund, and a bond fund if you want some stability. That's it. VTI plus VXUS at Vanguard, FXAIX plus FXAIX at Fidelity. You don't need 15 funds to be well diversified. Quick recap. An index fund is defined by what it holds. It tracks an index. An ETF is defined by how it trades on an exchange during market hours. The best index ETFs and the best index mutual funds are so similar that for most beginner investors, the choice barely matters. What matters is that you pick a low-cost, broad market fund, invest consistently, and don't panic when the market drops. The enemy of wealth isn't choosing ETFs over mutual funds. It's inaction, high fees, and emotional decisions. Choose any good index fund or ETF, automate your contributions, and let time do the heavy lifting.